Welcome back to our finance news channel. Today, we'll be discussing a recent finance article from TradingView that highlights how institutional investors are choosing between gold and Bitcoin during the ongoing bank failures and de-dollarization. Let's dive in. Bank failures, which started in March, have prompted professional traders to increase their exposure to gold futures while reducing their engagement with cryptocurrencies. This, according to a recent note by J.P. Morgan analysts. Traditionally, gold has been viewed as a hedge against potential catastrophes. However, it doesn't pay interest, making it less appealing when interest rates are high. With the bank crisis increasing the likelihood of a financial disaster, there's a chance the Federal Reserve might pause rate hikes or even cut rates. Meanwhile, de-dollarization, the process of countries moving away from the US dollar as the world's reserve currency, is also influencing the preferences of investors. As countries like Russia and China reduce their dollar-denominated assets, they have been turning to gold as an alternative. Bitcoin, on the other hand, is a relatively new asset with a limited supply and low correlation with stocks. Its proponents believe it could serve as a digital replacement for gold. Since regional banks began to struggle in early March, Bitcoin's price has surged by about 44% to $29,387. However, institutional and retail investors seem to have diverged in their preferences. Between March and early May, money managers heavily increased their exposure to gold futures, building a net long position of around $20 billion. On the contrary, retail gold interest, as indicated by ETFs, rose only slightly. Institutional interest in Bitcoin appears to have gone in the opposite direction. Data analyzed by J.P. Morgan suggests that money managers didn't buy into Bitcoin even as retail investors drove prices higher. There are several reasons why institutions might be hesitant to adopt Bitcoin as a hedge against catastrophe. For one, Bitcoin has only been around for 14 years and hasn't faced a severe banking crisis. Additionally, Bitcoin's price volatility significantly exceeds that of gold. Moreover, the U.S. is currently in the midst of a regulatory crackdown on crypto assets, which could have uncertain repercussions on token prices. Regulators have partly blamed the failures of Silvergate Capital Corp. And Signature Bank on their significant business with crypto companies, warning other banks against excessive involvement with cryptocurrencies. As de-dollarization continues, it's important to consider how this trend may impact the role of gold and cryptocurrencies in the global financial system. While Bitcoin has the potential to become a digital alternative to gold, its lack of a track record and regulatory uncertainty are currently keeping institutional investors at bay. As we previously mentioned, institutional investors currently prefer gold over Bitcoin as a hedge against potential catastrophes, such as bank failures and de-dollarization. However, the global financial landscape is constantly changing, and it's important to consider how these preferences might evolve in the future. For Bitcoin to gain wider acceptance among institutional investors, several factors need to be addressed. Regulatory clarity. The ongoing regulatory crackdown on cryptocurrencies in the U.S. and other countries creates uncertainty for institutional investors. Clear regulations and guidelines will be crucial for fostering trust and confidence in the crypto market. Price stability. The volatile nature of Bitcoin's price may deter institutional investors from considering it a viable hedge. As the market matures and liquidity improves, price stability may increase, making Bitcoin more attractive as a store of value. Infrastructure and custody solutions. Reliable and secure custody solutions are essential for institutional investors. The development of advanced and trustworthy infrastructure will be crucial in encouraging institutions to invest in cryptocurrencies. On the other hand, gold's status as a reliable store of value might be challenged by several factors. Digital alternatives. Central bank digital currencies, CBDCs, and stablecoins are gaining traction as digital alternatives to traditional assets. As these options become more widespread, they may attract investors who are looking for both stability and digital convenience. Changing macroeconomic environment. As global economies recover from the pandemic and interest rates potentially rise, gold's appeal as a non-interest-bearing asset may decline. Environmental concerns. Gold mining has a significant environmental impact, and as global awareness of climate change increases, investors may seek more sustainable investment options. The battle between gold and Bitcoin as a preferred hedge for institutional investors amid bank failures and de-dollarization is an ongoing and evolving story. As the global financial landscape shifts and new developments emerge, the preferences of institutional investors may change. Stay tuned to our channel for more updates on this fascinating financial rivalry. Don't forget to like, comment, and subscribe for more finance news and insights. Thanks for watching.